Hello and welcome to FinTech Diary. Every week we speak to an industry expert who's part of the FinTech revolution. In the world of FinTechs, which is based on constant evolution and innovation, we question changemakers, the founders, MDs, and CEOs on how they plan ahead and read the future developments. In every chapter of the FinTech Diary, we get the breadth and depth of every segment related to FinTech. My name is Amol Dete, and my guest for this chapter is Shashank Rishyasringa, MD and co-founder Capital Float. Shashank, glad to have you.
Excited to be part of this, Amol. Thanks for having me.
Thank you, Shashank. And to begin with, my first and the common question that I ask to all the founders and CEO is, please take us through your dashboard, your current dashboard in terms of how many employees do you have, what's the size of your company, what's your loan book, how many loans perhaps you disburse on a daily or a weekly or a monthly basis, are you profitable or not, how long will it take for you to profitable? Just share with us a dashboard.
Sure, Amol. So look, let me start with the customer, right? Because that's our North Star metric as a consumer finance company, right? So today we have about 5 million credit customers with KYC credit facilities. We are adding close to 1 million new customers every quarter. And so we've seen that grow almost 2 to 3x over the last year. And I think most importantly, we see a large number of customers using us on a regular basis as part of their needs, right? The second set of North Star KPIs for us is really around GMV and disbursements, right? And today we're clocking around $600 million plus of annualized GMV and are on track to cross a billion over the next few months. The third important piece for us is really stickiness, right? We want to build a product that customers see value in and keep coming back to. And so today, we're actually able to see over 100% plus GMV and revenue retention on every customer cohort, which means that we are actually starting to become a part of the lives of these customers. Now, customers, GMV, retention, these are all great metrics. But at the end of the day, this is a lending business, right? And so I think the single most important metric that we keep an eye on is our NPAs. And so today where we're at is we're at about a 1.5% loss rate on a cohort basis and about a 1% gross NPA on a annualized book basis. And this is keeping this under 2% is one of our core focus areas in one of the lowest actually for unsecured credit in India. These are our dashboard KPIs as we look externally. As we look internally, we're about a 500-person strong company and constantly adding some pretty exciting members to the team, especially around areas like product, data science, and risk, as we really see an opportunity to double down on our customers and build not just a couple of products, but a stream of features that can serve them as they evolve over time.
Okay, thanks for that dashboard, Shashank. Very meaningful. Let me take a few questions one by one, and starting with your experience in terms of the market, since you are into the consumer business lending, which sounds really good for every business or most of the financial institutions because that's where you make money. But again, it's not an easy business as well because of the NPAs and the risks associated with it. So I would like you to tell us how has been the market change since you started, and what do you see currently? Because when you started and where we are today, there is a big difference. There are thousands of players operating in this space, names that you cannot even recall, also doing a business of maybe 100 crores, 200 crores all the time. And obviously, the regulations are also there, which we will touch upon a little later. But how has market changed according to you, specifically in the consumer business or a lending business?
It's a great question, Amol. And I would say that three really big tectonic shifts in the markets have been in kind of three dimensions, right? The first has been infrastructure, right? And this is where we've seen a dramatic change over the last few years with the combination of smartphone penetration, digital access, digital identity through Aadhaar, and digital payments through UPI, now account aggregator, right? I think collectively, these 4 or 5 building blocks have scaled exponentially over the last few years. And actually today make India one of the most exciting markets to build from a fintech and financial services perspective, right? If you think of it as a customer today, the friction around validating your identity, sharing your data for a product, and being able to move your money have basically been brought to zero. And no market in the world has ever achieved this the way India has. And so I think especially with the launch and stabilization of account aggregator this year, we should start to see a step jump increase in digital lending transactions over this baseline infrastructure. I think the second big thing, Amol, that has changed is actually commerce, right? The nature of credit is that it follows commerce, right? And what we have consistently seen over the past few years is the shift of commerce from being entirely offline to being digital and online, right? COVID accelerated this journey by shortening like a 5 year um, period to maybe about a year or two. And I think there's no going back, right? And so today you have about 150 million customers who are actively shopping online, right? And using various modes of digital payments to actually buy things. And the interesting thing is that less than 30 million of those customers actually have a credit instrument that they can use for such purchases, right? So that gap is really what we are going after at Axio. And the third is, it's not been all smooth sailing, right? In the West, I think folks are now talking about what it means to go through a downturn and a rising rate cycle and a slowing of consumption. But the reality is in India, over the last 4 years, we have actually been through a series of macro shocks, right? From GST rollout to the ILFS-led NBFC crisis and then the lockdowns during COVID. All of these put the economy on the back foot for a period of time and created spikes in delinquency rates as well as interest rates, right? And so today, actually, when you look at the Indian economy, it's actually been through a period of ups and downs. It has become more resilient. Belts have been tightened. And so as we now look towards a global macro that is more uncertain than it's ever been, we actually believe that India is in a much better position to weather these storms and emerge stronger. And that makes the outlook for India from a credit perspective actually more exciting than many other parts of the world.
Very detailed one, Shashank. In fact, infra and commerce, I absolutely agree. And one I think notable thing here is despite these macro shocks, the fintech still emerged as a strong leader. Now we are seeing a little difference in terms of the raising funds, but I think in last 2 years, fintech still managed to raise significant number of funds. A lot of fintechs have become unicorns despite all these challenges. So, considering all this background, Shashank, now the question again, I will take it forward from where I started with my second point is how do you think that the fintechs operating in lending space will shape up now? Because the competition is huge. Every fintech used to operate in wallets or some other payment space shifted to lending business today. Even the banks have started their own lending apps and they're also getting into the digital business. They're also partnering up. So I know there is a lot of growth potential specifically in the credit segment. Credit is a hungry, India is a credit hungry country. But considering all these competitions, which is very high, and there are various products, whether BNPL, pay later, SME businesses, MSME businesses. How do you see the whole lending business shaping up?
Yeah, it's again a very, very pertinent question, Amol. And I think the way we see it is there are actually two distinct ecosystems for fintech in India, right? If I look at these 150 million people as the current addressable market, right? Because they are online, they use UPI, they have digital footprints. There is a prime ecosystem of about 25 to 30 million people who have credit cards today, right? And these customers actually have 2.6 credit cards per person. And a lot of the fintech activity today is actually focused on these customers, right? Because the risk is proven, right? And these customers are also the most savvy in taking digital products, right? And I think there what we're seeing now is a lot of competition and potentially a race to the bottom on margins because everyone is chasing the same set of high quality or so supposedly high quality customers, right? And these are people who work in, Cat A companies, have taken multiple loans, have a very high CIBIL score, etc., right? I think there is definitely a risk of saturation in this segment, and we're going to have to be watchful about over leverage here, right? Equally, there is a second ecosystem which I will call the non-prime ecosystem, right? These are the 100 million odd people who are buying online and using digital transactions, but don't have a credit card, right? This segment is wide open, but the risk in this segment is still to be discovered, right? And I think players who enter this segment have to have a risk first mindset, right? Because the key problem to solve initially is actually NP and delinquency, and then figure out how you sell and build additional products for this customer base, right? It's what we at Axio call a low and grow approach, right? We want to enter these customers' lives with small amounts of credit, give them a chance to prove their repayment history, and then use that repayment track record to actually be able to upgrade them to larger financial products over time. This second ecosystem, the non-prime ecosystem, is wide open today. And even the existing players are serving a tiny fraction of this market, but it requires very strong focus on risk. And it's a long game. It's going to be a 5 to 10-year plus game to really crack this market meaningfully. So I think it's actually a very different story depending on which ecosystem you look at.
No, certainly, no doubt about it. So I think it's a very clear statement, a risk first mindset and low and grow approach that you think is the best for the lending companies and for you as well. Now, Shashank, let me divert your mind to the recent guidelines which RBI has released. That is the talk of the town. We recently also conducted a small webinar on it, and everybody wants to know what next. Uh, Surprisingly, and in fact, that shows in fact RBI is kind of progressive because it nowhere says that okay, let's ban fintechs. Nowhere says that okay, we are not interested in fintechs. It's more like how can we streamline the structure? How can we put everybody under the frame and make them accountable so that innovation will be there and the digital lending will also happen. On a broadly, if you look at those guidelines, obviously there are a lot of nitty gritties. So that's one good part. But I'm so sure that the fintechs will have a tough time following all those things because ultimately regulated entities, the banks and the financial institutions, the NBFCs will also go a little strong. So my quick question to you specifically is, how do you see these guidelines panning out specifically on the fintechs? How specifically your relationship will be with the fintechs going ahead?
So Amol, I think you have actually a very enlightened take on this, right? There's been a lot of noise about these regulations, but you're completely right. These regulations do two or three things. One, they actually acknowledge the entire ecosystem and they say that there are different players. There are regulated entities, there are LSPs, there are data providers, etc. The second thing it does is it places a lot of onus on regulated entities, right? And it requires regulated entities to be responsible for the entire value chain, even if they work with LSPs. And the third thing it does is it actually talks about the creation of a self-regulatory body that will establish a code of conduct across both regulated and unregulated entities, right? These are all very positive things. And if you actually look at it, the microfinance industry followed a very similar trajectory in the 2000s and ended up with the creation of two SROs that have been very successful in the industry, right? And so we believe that the digital lending industry is following a similar trajectory and it's a good trajectory, right? What it means basically is some players will have to choose whether to be regulated or to be LSPs. For example, we have made the choice that given that we want to be able to manage the customer experience on a full stack basis, we needed to be a regulated entity upfront. And so we've been an NBFC since day one, right? That's going to become a really important design choice that people have to be very thoughtful about. The second is that players are going to have to go above and beyond the regulation and set a higher standard for themselves. So for example, within DLAI, which is a Digital Lenders Association of India, where we are a member, we have about 100 members that have adopted a code of conduct for ourselves that goes beyond what the RBI says and actually lays out certain rules on scraping, consent, data privacy, etc., right? And so I think players are going to have to decide if they want to actually self-regulate or if they want to be outside of that. And there will be a clear focus from regulators and also eventually from customers on entities who are part of the self-regulatory ecosystem, right? So I think these are two big choices and people are going to have to make them. And we believe it's actually a good thing for the industry.
Noted. But considering, the compliance is going to be an interesting thing here and REs, I mean, specifically the NBFCs like you or the banks which are going to partner or having partnerships with fintechs will have to, ensure that the fintechs are following everything. So do you by any chance see now the compliance cost is going to go up and which can be a little burden for both the banks, NBFCs and also the fintechs?
Amol, we have a slightly different point of view here. Compliance is a part of this business, right? You cannot build a financial institution, take risk, give credit without having compliance as a key part of your stack, right? So the reality is maybe the costs do go up in certain places, but ultimately being a lender and or being part of the lending value chain means embracing compliance. And I think a lot of players, including ourselves, have already been following a lot of these rules. Right. So it is part and parcel of the game and it's required and it is it is actually integral to the future of the ecosystem.
Yeah, sure. So one more question here, Shashank. I'm sure you must have gone through the whole guidelines again and again. Must be by hearted by now. And there are a lot of obviously changes, suggestions, recommendations. Considering whatever is given there, what else do you think is needed specifically from the policy perspective to push digital lending to a next level, or maybe to scale up digital lending in a manner which will be, one, compliance driven, would be also seamless, and it would be also, completely nuisance free.
So a few things, right? I think if I start off from the circular that came out, right? I think the creation of this self-regulatory architecture is going to be very crucial, because it needs to be laid out in the next few months so that the rules of the game become very clear for players and consumers. And I think whatever we can do as an industry to get this up and running and get it clarified is going to be a game changer, so that there is no ambiguity around what can be done and what cannot be done. Right? That's point number one. I think the second thing that is essential is an expansion in some of the infrastructure. Right. So KYC, as an example, today exists for individuals, but digital KYC for, let's say, micro entrepreneurs or people running a small business is still a work in progress. Right. I think account aggregator has made a really good start, but ensuring that all the banks plug in and that multiple data sources beyond just banking data comes into the AA system is going to be really important, because that's a bet that many people have taken 5 years ago when AA was first announced. So I think this is also going to be a big thing. And I think the third is actually going to be partnerships, right? I think we've all seen that in India. We talked a lot in the beginning of, FinTechs versus banks. The reality is it's FinTechs and banks. So in many cases, FinTechs with banks, right?
Hmm.
And so I think any groundwork that can be done to create a smoother way for banks to collaborate with FinTechs, whether they're FinTech NBFCs or FinTech LSPs, will go a long way in unlocking liquidity for the overall ecosystem. And I think there's a lot of room, because even today, if you look at it, it's still a very small ecosystem of banks who actively collaborate with FinTechs, right? And there's a potential to open up a much larger set of players to work on these partnerships.
Noted your point, Shashank. So now, let me come back to again a lending side. And when you said that you have been dealing with 150 million customers, what is your experience, Shashank? How has been these customers? I mean, what are they actually looking for? I know the whole, the millennial and the Gen Z crowd is completely different from the kind of customer used to be there maybe 2 decades ago, and their demands are different. But what are your readings specifically about the completely new market or completely new credit market? What kind of consumer behaviors do you see?
So to start with, Amol, I think these consumers are looking for digital first products, right? This is a generation that has grown up on its smartphones and buying on e-commerce sites like Amazon. So they are looking not for products that have an offline component. They are looking for products that are built online first, right? And that is a crucial difference from a thinking perspective, right? The reason why checkout finance, for example, right, which is what we do with many merchants, has worked so well is that it actually is a digital first product, right? It's, in many ways, it's the next iteration of unsecured credit at the point of sale. And so I think this desire to have financial products that are built digital first and digital only is a big one. I think the second thing is that this generation is looking to actually progress in life, right? So climbing up the credit ladder has becomes a very, very important objective. I remember when I was a student in the US, there was this sort of chakravyuh that you got stuck into after you graduate and enter the workforce, where if you didn't have a credit card, you didn't get a credit card, and if you had a credit card, you got a credit card, and it was just like this loop that you kept going into, and you could never break out of it, right?
Right.
And I think the next generation in India that is working, either running a business or working in companies, is looking for a transparent way to climb the credit ladder. They're happy to start off with 10, 20, 30,000 rupee credit products, build their credit history so that over a period of time they can take control of their destiny when they want a credit card or a home loan or a car loan or an education loan, or even to meet household purchases that come up like a TV or a fridge or education, etc. Right? So that concept of building your credit history, right, has really become embedded in the ecosystem in India. And young people want to climb that credit ladder responsibly. And the third thing is this idea of responsible, right, that I ended with, right? We believe fundamentally that this generation is very, very smart financially, right? In many ways, more financially savvy than the generations that came before. And so they are looking not just at credit as a tool, but they're also looking at finance as something that they want to get on top of, right? We see a lot of young customers using our app to manage their money, right? We see people using a credit line to buy something and at the same time creating a budget on the app, right? To ensure that they save enough over the next few months to meet a certain goal, right? So this combination of being able to use credit smartly to achieve your aspirations, but at the same time manage your money thoughtfully to ensure financial discipline and long-term planning is retained, that is a very unique feature of this generation. And we think they are hungry for tools to achieve this balancing act between, the right level of saving and the right level of borrowing.
Okay, so that's a very interesting point. But are the customers more going for in the BNPL specifically, the customer borrowing was specifically about the products or maybe for the aspirational goals, which is completely different from what we used to do earlier, personal loans for maybe car or home or something like that. So is that trend still going very high? I mean, is the aspirational borrowing more or is a need-based borrowing more? By any chance, have you looked at this data?
Honestly, well, it's hard to comment on the data yet, but there's some trends I can call out for you, right? Look, I
Sure.
think financing at checkout for products has been around for decades, right? People have been going into a Chroma or a Reliance Retail and buying a TV, a fridge, etc. on EMI. It has been core to India because the reality is we have an affordability gap in this country, right? And people need ways to smoothen out their expenses
Hmm.
for products that are within their reach, but they need some help to make sure that they are fully within their grasp, right? The main thing that has changed is actually the shift from offline to online, right? Now, a lot of these customers who earlier went to a store are actually going online to an Amazon or to a Make My Trip to buy these products, right? The second thing that's happening is these physical products, right, are coming into the reach of tier 2, tier 3, and tier 4 cities because earlier people in these cities perhaps didn't have the kind of large, like high street retail offline that they could go to. But today they have leapfrogged high street retail and are going straight to online to buy products that their counterparts in Mumbai, Delhi, or Bangalore always have had access to, right? So these two trends of offline going to online and tier 2, tier 3, and tier 4 India getting access to consumer durable products are actually two of the biggest drivers in the checkout finance or BNPL trend that you're seeing, and at least what we are seeing in our business.
Noted your point, Shashank. One or two more questions are important one specifically from the industry perspective. So we have a fintech rally. A lot of fintechs are there. Banks are also quite active specifically, and they're also partnering and collaborating with the fintechs. So on side, this combination looks really nice. On the other side, a lot of fintechs have been raising funds, but there are certain issues now. The investors have also are going a little slow. I'm not saying complete fintech funding winter, but at least there is some dull side that we are seeing right now. So, according to you, where is the fintech rally of India heading now, and where will it head? Uh, will it go through a bumpy ride going ahead? Will it go through a dangerous ride going ahead? How do you see the whole fintech rally? And how do you see the journey going ahead for a fintech?
Amol, I have a perhaps controversial point of view here. I actually think eventually everyone will be a fintech, right? Banks will be fintech, NBFCs will be fintech, fintechs will be fintech, right? It's a way of doing business rather than a specific type of company, right? Now, within that ecosystem, I think there definitely will be winners, and winners will be people who specialize in certain types of customers or products and are able to do them really, really well. And when I say do them well, I mean everything from user experience to risk management to compliance and funding, right? And what you're going to see over the next few months and years is market leaders being created in these kind of categories, right? And in some cases, it could be a new age tech NBFC like us that becomes a market leader in a category. In some cases, particularly in spaces like home loans and others that both have a hybrid online offline component, it could actually be banks, right, or large scale NBFCs. So the reality is, I think there is going to be clear leaders, and that leadership is going to be driven by being very good at serving certain niches and certain products, right? And that is where alpha is going to get created. As opposed to, let's say, the previous generation of financial services where you had a lot of large kind of horizontal platforms who did many things for different people.
Certainly. And what next for you, Shashank? Uh, I mean, you have large number of customer base now, already a licensed entity, and already doing number of customers. I mean, as you said that 1% GNPA is again very low. 150 million customers is a strong customer base. So considering all these backgrounds and shaping up the whole digital lending industry in its own way, where do you see capital flow maybe in next 2 to 3 years? What kind of changes do you see in the company? And more importantly, are you going to raise more funds? Are you going to hit the capital market? Yes, are you also thinking about IPO? So what are those ideas that you have for next 2 to 3 years?
Sure, Amol. So I'll start with your questions backwards. So
Sure.
while I can't comment on fundraising plans, money is a raw material for this business, right? So we're constantly engaging with debt providers, bank partnerships, etc. Right? Our vision is definitely to build a financial institution in the long run. We want to be financial partner of choice for these 100 to 150 million customers who are digitally native but aren't well served from a credit perspective, right? That's our North Star. In terms of what's next, right? As you correctly said, we built a strong customer base. We have a customer base of about 5 million customers now, an opportunity of 150 million ahead of us. I think we'd like to be able to do two things, right? The first is we'd obviously like to reach as many customers as possible. Like we like to keep, doubling and tripling this customer number. We've already more than doubled from last year. I think we said we would get from 2 to 4 million customers in a year. We actually beat that target last year, right? So we'd like to keep double and tripling our customer base over the next few years. But the second, I think, more important thing for us is we want to actually build credit responsibly for these customers, right? And that is actually at the heart of our brand unification to axio, right? Axio means worthy in Greek, and we actually believe that having already built credit, been through risk cycles, delivered products to several million customers, it was time to set a more ambitious goal for ourselves, right? And we believe that if India is to grow at 8-9% GDP growth over the next few years, credit has to grow, retail credit has to grow at 2x that. And the only way to do that, right, once you've got the tech in place, is to make that growth sustainable, because you don't want to have accidents along the way. So the challenge we have set ourselves is how do you actually create sustainable credit products, right, that are worthy for the next 100 to 150 million customers, right? And this is not just an aspiration. We are actually concretely working on a few areas within this, right? We are working on how do we design products that are transparent, right, where customers understand the credit that they're taking. We're working on designing policies that give customers the right level of leverage that doesn't over leverage them, and where they can take a low and grow approach, as you said, to scale as they scale. And thirdly, we're trying to create a portfolio of products that can serve different needs at the right time, so that customers don't need to take credit when they don't need to, but when they need it, they can take exactly the right product for themselves at the right pricing, at the right terms, and the right level of transparency, right? So how do you make credit good? How do you make it sustainable, both within our ecosystem as Axio, but ultimately for the country? That is sort of the big, hairy goal that we have set for ourselves over the next 5-10 years and beyond.
Meaningful one, Shashank, and I think wish you all the best. I'm sure you will achieve that goal. Thank you so much for taking out time and sharing your inputs here. It was really nice talking to you, Shashank. And yeah, that's the wrap, ladies and gentlemen. Click on the FinTech Diary tab to view our previous episodes as well. If you like it, please don't forget to share it on social media as well. Please ensure you are subscribed to our daily newsletter, which is absolutely for free. Thank you so much for watching. And Shashank, thank you so much for again taking our time and sharing meaningful insights here.
Thank you, Amol. Always a pleasure to chat with you.